right, everybody, our boy Bill, he has a theory of what's going on, and today we are going to explore our boy's Bill's theory in depth. So let's get into his pinned tweet that he talked about. I'm going to try to analyze and give my analysis as well as we are reading it. Over the past 2 weeks, rates have declined dramatically, reportedly due to fears of a recession. Friday's move was particularly stunning for the scale of the move and for the degree of the intraday volatility. I put forth a theory here of what is going on. Bill Ackman and his theories. Let's read it. On the risk of a recession is defined as a 2-quarter decline in real as opposed to nominal GDP. In a highly inflationary economy, it is more difficult for nominal spending and growth to exceed inflation. In order, therefore, for today's economy to grow on a real basis, nominal GDP growth must be more than 8.6%, because 8.6% is the reported inflation rate, which we all know is probably higher than that, which is a difficult hurdle to exceed. Nominal GDP growth is not going to grow at upwards of 9%. That doesn't happen. It has been 40 years since we have experienced inflation at current levels, and as a result, market participants are used to a world with 4 to 5 nominal GDP growth and 2% inflation. More GDP growth with 2% inflation, 4 versus 2, actually allows the economy to keep going and stabilizes everything. But inflation at 8% is a different issue. With inflation at 2%, nominal GDP growth need only to decline from 4 to 5% to less than 2 to 3% for 2 quarters in a row for real GDP to be negative and for the economy to be deemed in a recession. 2 quarters of negative GDP growth does not, however, seem to be a reasonable definition during a period with high inflation. So he's sort of contesting the type of traditional economic definition we have about 2 quarters with GDP decline in a time where inflation is just incredibly high, particularly when inflation has spiked to nearly 9%. Nominal spending growth of 8% for the last 2 quarters would technically put us in a recession, but this does not make sense fundamentally. The economy is continuing to grow rapidly on a nominal basis. Consumers are spending substantially more this year than last. There are about 2 times as many job openings than people looking for work. The unemployment rate is at a 50-year low, about 3.6%, I believe. During COVID, it got up to about 15%. Wages are rising substantially, and it's hard to find workers. Now, this is a little bit in a disagreement with Kathy, who says consumer demand is going down. It might not be that much of a disagreement because consumers are still spending more, but if that demand is slowly starting to decline as a result of the University of Michigan study, which is the most trusted study around consumer sentiment, then that means that spending may start to go down a lot more. Q2 revenues and earnings growth should be strong for most businesses. So here's the big thing that he says that I wanted to talk about real quick. I don't know if this is true. If this is true, then the stock market's going to be in a really sticky situation, because if earnings are good, then the stock market really doesn't know what to do. Because like if the macro is bad, inflation's bad, interest rates, all this stuff, and then earnings tank, like Tesla does horrible, Facebook does horrible, like objectively horrible, the stock market is allowed to sell those off without feeling regret. They're like, okay, Facebook at 150, way too expensive, macro sucks, they can't even keep up their ad revenue, boom, we're just going to sell it off. But if Facebook blows earnings out the quarter, or Tesla blows earnings out the quarter, you're looking at an economy that's like, wait a second, how can we dare sell these stocks off when they are growing so well just because the macro sucks? There's a disconnect here. So the market likes when there's stability and when there's certainty, and if it's certain that these companies suck, they can easily sell them off. If they don't suck, but the macro sucks, it's in a weird, tricky position, almost kind of like, what do we do? Do we sell? Do we not sell? Bill thinks it's going to be good. With earnings misses and margin declines for some companies which have limited pricing power. Consumers have approximately $2.5 trillion of excess savings, while there is a mixed shift underway from goods to services. Overall demand is extremely strong. Again, this is a disagreement with Kathy Wood. We have a supply, not a demand problem. Kathy fundamentally disagrees with that as well when it comes to inventories. This does not seem like a setup for a true economic recession, regardless of the favored definition. So why have rates declined so dramatically, particularly short rates, when the Federal Reserve has, let me just go back to that, has become increasingly strident about the need or aggressive tightening to bring inflation back down to 2%? The answer, I believe, is largely due to some misunderstanding about what a recession is, but more importantly, the technical factors that are driving volatility and the downward move in rates. Market participants speculating in fixed income market, particularly hedge funds, often use enormous amounts of leverage because it is available and it allows one to make a windfall of profits if you get the trade right. This is like what he did, betting kind of with 27 million, and then you get 2 billion back if you're shorting the market that high. So like when you bet with a lot of money, you get a lot of money back. The bet that rates would rise became one of the more crowded trades in history going into June 15th. As speculators covered their shorts on the Fed news, rates began to decline, causing substantial mark-to-market losses, particularly for levered participants who were forced to choose to cover. With more data points emerging indicative of a slowing economy, the recession narrative took a hold, causing a further decline in rates, contributing to even more losses, short covering going into the quarter, and when exposure are required to be disclosed in investor reports and financial statements. Extreme limited liquidity going into the July 4th holiday compounded the move and the volatility and pain for levered market participants as traders looked to and in many cases were forced to exit or didn't wish to hold open positions over the long weekends. So what happens next? Basically, the argument he's been making is that things sucked. Things are kind of the narrative of things sucking continued to make things suck. People were levered against betting if things would suck or not suck, which ultimately led to how things are currently, which is kind of sucky, but the market's kind of rallying, but maybe it's a dead cat bounce. We kind of don't know. Powell is committed to do whatever it takes to quell inflation, even if doing so creates a increase in unemployment and a recession, which would be demand destruction, that would lead to a recession. Inflation is not coming down soon. Housing and rental costs, energy, food, and supply are constrained, and higher prices are unlikely to abate for the foreseeable future. Wages are continuing to rise as immigration has been limited. Many have exited the workforce, and the balance of power has gone from the companies to the labor forces. Companies are raising prices because they must in order to cover their costs and because they can. The wage price spiral is underway. What this means is if you're making $8 and now you're making $9, the burger you were paying for that was $4 is now $5. So the nominal purchasing power that your wage gives you as an increase is mitigated. It's washed by the price of the things you're paying for with those wages that are spiraling, which means you don't have the ability to actually have any true wage momentum and a raise because the things you're buying just cost more money. That's what happens when inflation happens. While demand is moderating due to stickier shock in inflation as well as rising rates, overall demand rates remain strong. Again, this is the disagreement with Kathy. Inflation has become embedded in daily experience, in headline news, and a dinner table topic for all. Savings bond paid 9.26%. Or 9.62%. In order to stop the inflationary spiral, the Fed will need to rapidly raise rates to 4 to 5% by next year, which hopefully will be enough to snuff inflation. The mild and transitory inflation being priced by the market as of Friday is a fiction, meaning he's saying it needs to be worse in the context of, or quicker in the context of interest rates. Rates are going up a lot soon. The sooner the Fed quells inflation, the better for long-term bonds and long-term financial assets like equities. Don't be misled by short-term, technically driven market movements, which is what's happening right now in terms of the crazy rally we saw yesterday. I mean, I was up like $2,000 in a day. That's the short-term technically driven market movement. Stocks of high quality businesses with long-term growth and pricing power look cheap. Don't forget that the stock market measures nominal business value. Inflation is hurting business and consumer confidence and slowing growth. Killing off inflation will save the economy in the longer term at the expense of short-term pain, which means even if we increase rates now to 4, 5, 6%, which is unheard of in the past 20, 30 years, it will still help the economy long-term because we got to get rid of inflation. Let's hope the Fed gets it right. I welcome your input and rebuttals. And yes, we put our money where our mouth is. I've often wondered why investors who share their views are criticized for holding investments. He's talking about, going short during COVID. We are 100% long, high quality businesses, growth businesses with pricing power and own hedges on which we will profit if rates rise. So they are long, you could say a company like NVIDIA. I don't know if they're long NVIDIA, but that's like a high growth tech business. But they have hedges in place in case interest rates rise so substantially that those growth businesses obviously have their valuations compressed because when interest rates rise, it's not good for high growth tech companies. So our positioning, as always, matches our thinking and our stated views, which means when he says we're 100% long, high quality growth businesses, he's putting his money where his mouth is because he says these businesses are cheap. And he's recognizing how incredibly cheap they are because of strong demand and because consumer confidence is still strong in the economy and Q2 earnings are going to be good. However, they have hedges in case rates rise exponentially, which is what he thinks it should happen theoretically if we want to quell inflation in order for them to profit both ways. And that's why he runs a hedge fund. That's the job of Bill Ackman. Now, the interesting thing about this is that this is, again, I've been saying it a lot, but it's contrary to what Kathy thinks, because Kathy thinks a recession, rates don't need to rise because inventories and supply is so substantial and the technology that is so innovative will lead to deflation, both of those factors, that the Fed doesn't need to rise interest rates. Kathy obviously has an ideological agenda that doesn't want interest rates to rise because it hurts all of her stocks because all in the high growth tech. There are no hedges against value plays or some type of plays if the market goes down in terms of shorting stocks because it's an ETF, it's not a hedge fund. So her argument is like, we don't need to raise rates because A, it's going to screw my companies, but B, inventories, the excess inventories that we have, consumer demand going down, which means it's better because less people want to buy a TV, so there's more TVs, so that if there's more TVs, the price of a TV will go down. And the technological innovation that's happening will lead to massive levels of deflation, which is a good thing if she's right. But if she's wrong and inflation continues to spike up or rates need to rise in order to destroy demand and we have to induce a recession, then Bill Ackman would be more right here at the end of the day. It's going to be interesting to see what happens. Ackman versus Kathy Wood. Definitely some different disagreements on the spectrum of where the economy ultimately is going. Let me know your thoughts in the comments. Let me know what you think. Is Bill Ackman right? Is he right to be saying that we need to raise rates really quickly and have that short-term pain? Or will inventories and innovative tech lead to more deflation in the future? Thank you guys so much for listening. I'll see you in the next one.